Welcome to another BAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over BAR Area 2. This is Section G. This is a remembering and understanding topic. Recall the basic functional currency concepts, including the indicators to be considered when determining a subsidiary's functional currency. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And then after you're done watching that, you're going to want to learn more, so make sure you also check out becoming a Superfast CPA Pro member. Pro members get access to a lot of great stuff, including the full versions of these YouTube videos. So in today's video, we are only going to be doing 5 questions, but Superfast CPA Pro members will get access to the full 10-question version of the video where they can get a little bit more help and a little bit more understanding. So again, if you like this and you like our other products, make sure you check out becoming a Superfast CPA Pro member. Now with all that, let's dive straight into the questions. Okay, here we are at question 1, and something I always like to point out if it's an option is you want to read the last sentence of a question first. This is a very good strategy for figuring out what a question is even talking about, and it will help you be speedier on test day, because you have no idea what you're going to be seeing on the exam, and reading the last sentence first frequently will give you the context for what the question is about. So again, you read the last sentence first, and then you go through the rest of it so that you already have the context. So let's do that here. Based on the indicators of functional currency, which of the following is most likely Delfra Inc.'s functional currency? Let's go up to the top. Delfra Inc. is a wholly owned subsidiary of a U.S. corporation. It operates in a country that uses the South African rand, or ZAR, I hope I'm pronouncing that right, as its official currency. Delfra's key financial characteristics are about 75% of its sales are to local customers and are both priced and settled in ZAR. Export sales, roughly 25%, are invoiced in US dollars, but the selling prices are first determined in ZAR and converted to USD at the spot rate on the billing date. The majority of its expenses, including wages and materials, are paid in ZAR. Long-term financing and intercompany loans are provided in euros, and Delfra maintains its accounting records and prepares its internal financial statements in British pounds. Okay, so again, based on the indicators that are here, which is the most likely to be the functional currency? Now, if you know what functional currency means, then you probably already have an idea of what the answer is. But if you have no idea what functional currency is, if you've never really seen anything like that, that's okay. We are using this question and the questions in this video to learn about functional currency and how to determine that and everything like that. So let's go ahead and dive into the explanation for this. Okay, here we are. The answer is D, the South African rand. Again, the ZAR is the functional currency in this situation. You could have maybe thought it was the USD, but it's the ZAR in this situation. So let's read through this to learn a little bit more. The functional currency is determined by the currency of the primary economic environment in which the entity operates. Primary indicators include the currency that influences sales prices and customer payments, operating costs such as wages and materials, and the local economic environment. Secondary indicators include the currency of financing and the currency used for record keeping. So, because the bulk of Delfra's cash inflows, which was the local sales, and virtually all of its cash outflows, the wages, materials, other operating costs, are in the South African rand, and even its export prices are set in ZAR before being converted to USD, the South African rand clearly reflects the entity's primary economic environment. Long-term financing in euros and record-keeping in British pounds are only secondary factors. Therefore, ZAR is the functional currency. Again, functional currency is what most of the sales prices and customer payments, the costs, and the local economic environment are going through or associated with. So even though they do some things with the US dollar and with the euro and with the British pound, they mainly use the South African rand as their main currency for their day-to-day stuff. So that's why it's the functional currency. So we learned a little bit more about functional currency in this question. Now let's go to the next question. Okay, here we are at question 2. Let's go through this. Which of the following factors provides the strongest evidence for determining an entity's functional currency as it relates to identifying the entity's primary economic environment? So we learned a little bit about this in the first question, so you might be able to pick your way through this. Let's go through the options. Option A, the currency in which the entity receives long-term financing from its parent. Option B, the currency used for preparing and maintaining the entity's financial statements. Option C, the currency that mainly influences the entity's sale prices and the cash received from customers. Or option D, the currency in which the parent company operates. Again, just based on what we learned in the first question, you probably already know the answer. Think about this if you want, but if not, let's go ahead and take a look at the explanation. Okay, here we are at the answer. C, the currency that mainly influences the entity's sales prices and the cash received from customers. That probably wasn't too hard to pick out because, again, we kind of learned that in question 1. So let's go through this explanation just to kind of dig a little deeper into this. The primary economic environment is the one in which an entity primarily generates and expends cash. The most important indicators include the currency that influences sales prices and in which sales are settled, and the currency of costs such as labor, materials, and other operating expenses. That's the main economic indicators for the functional currency. Option C points to revenue-related cash flows, which are one of the strongest indicators of the functional currency. The other options are secondary indicators or are not relevant. So option A was financing, and that's a secondary factor, not primary. Option B is reporting currency, which does not determine functional currency, which, by the way, reporting and functional currency are separate, or like that's a separate definition. And then option D, the parent's currency may influence but does not override the local economic factors. So the parent's currency does not necessarily influence or require the subsidiary's functional currency to be the same as the parent's currency. There might be some situations where they could influence it to potentially be that, but it doesn't have to. So again, the main thing here is that we want to look for the currency that influences the sales prices and the cash received from customers and the costs. So with that, let's go to the next question. Okay, here we are at question 3. Which of the following best describes the difference between a subsidiary's functional currency and the reporting currency used in consolidated financial statements? Okay, let's go through this. Let's go through the options. Option A, the functional currency is chosen by management, while the reporting currency is determined based on the parent's operations. Option B, the functional currency reflects the primary economic environment of the parent, while the reporting currency reflects the country where the subsidiary operates. Option C, the functional currency and reporting currency must always be the same for a foreign subsidiary under US GAAP. Or option D, the functional currency is used to measure a subsidiary's financial results, while the reporting currency is the currency in which the consolidated financial statements are presented. So again, we talked a teeny bit about reporting currency versus functional currency in question 2, but if you have no idea what the difference is between those, that's okay. We're going to use this question to learn that. But if you want, give it a guess, and when you're ready, come back, we'll look at the answer together. Okay, here we are at the answer. D, the functional currency is used to measure a subsidiary's financial results, while the reporting currency is the currency in which the consolidated financial statements are presented. And, that kind of makes sense. Reporting, it's kind of in the name that it would make sense that the financial statements are going to be presented in that currency. So let's go through this. The functional currency is the currency of the primary economic environment, we've talked about this, in which the entity generates and expends cash. It reflects the environment in which the subsidiary operates, not necessarily the parent's currency. They could be the same, but they don't have to be. Now, the reporting currency is the currency in which the parent company presents its consolidated financial statements, typically the currency of the country where the parent is headquartered. Now, when a subsidiary's functional currency differs from the parent's reporting currency, foreign currency translation is required to consolidate the subsidiary's financials. So they have to translate the functional currency into the reporting currency if it is different. Therefore, option D correctly distinguishes these two concepts. The other options misstate the relationships or rules under US GAAP. So again, just to kind of make sure that that's clear, the reporting currency is the currency that is going to be used for the consolidated financial statements. And that's typically the currency of the country wherever the parent is headquartered, because that's where they're probably going to be releasing their financial statements. But the functional currency can be different, and that is, again, going to be mainly based on the primary economic environment in which it generates and expends cash. So there is a difference between the two different kinds of currencies. Now let's go to the next question. Okay, here we are at question 4. Under US GAAP, in what currency does a foreign subsidiary measure its assets, liabilities, income, and expenses in its standalone financial statements? So when it's just the subsidiary's financial statements, how do they represent their assets, their liabilities, and everything like that? Let's go through the options. Option A, the currency used by the parent company to prepare consolidated financial statements. Option B, the currency of the country in which the subsidiary is located. Option C, the functional currency of the subsidiary. Or option D, the currency used in the majority of the subsidiary's financing arrangements. Okay, so based on everything we've learned, you probably already know the answer, but if not, pause the video if you need to and think about this, and when you're ready, come back, we'll look at the answer together. All right, here we are at the answer. C, the functional currency of the subsidiary. That probably was pretty easy, so let's go through this. Just like in other videos, we're kind of just hitting home the concepts that you need to know, even if it's across multiple questions. So let's go through the explanation. A foreign subsidiary measures its financial results in its functional currency. We've been talking about this the whole video, which is the currency of the primary economic environment in which it operates. This includes the currency that influences revenue generation, expenses and cash outflows, and the local economy. Even if the subsidiary is located in a different country or its parent uses a different reporting currency, the subsidiary's assets, liabilities, income, and expenses must be measured in its functional currency. Translation to the parent's reporting currency, maybe something like the US dollar, occurs only for consolidation purposes, not for the subsidiary's own accounting. When they're doing their own accounting, they're doing it in the functional currency. Now with that, let's go to the next question. Okay, here we are at question 5. Before the parent can consolidate Radion's financial statements, what must occur and how are any resulting gains or losses reported? Let's go up to the top. Radeon Ltd., a foreign subsidiary of a U.S. company, maintains its books in the local currency of its country, the dinar or dinar. I'm not 100% sure how to say that, just kind of found it. However, based on U.S. GAAP functional currency indicators, Radeon's functional currency is determined to be the U.S. dollar. So again, before the parent can consolidate Radeon's financial statements, what must occur and how are any resulting gains or losses reported? So let's go through these options. Option A, the dinar or dinar-based financial statements are translated to USD using the current rate method, and gains or losses are reported in other comprehensive income. Option B, the financial statements must be remeasured into USD, and any resulting gains or losses are reported in continuing operations on the income statement. Option C, the dinar-based financials are translated to euros as an intermediary step, and any gains or losses are deferred until the subsidiary is sold. Or option D, the financial statements are translated using historical exchange rates for all accounts, and gains or losses are reported as a prior period adjustment. So this one's a little bit different. It's basically talking about what happens when there is a functional currency, but you're doing that translation or that remeasurement. How is this working? If you know this, that's great. If not, that's okay. We're going to use this question to learn another new thing. So let's go ahead and go to the explanation together. Okay, here we are. The answer is B. The financial statements must be remeasured into USD, and any resulting gains or losses are reported in continuing operations on the income statement. So let's go through this. When a subsidiary maintains its books in a currency that is not its functional currency, so we learned in the previous question that they should be doing it in their functional currency, or most likely they usually do it in their functional currency, but if they're not, the financial statements must be first remeasured into the functional currency using the temporal method. So what is the temporal method? Well, we're going to talk about what it involves. This process involves monetary assets and liabilities being remeasured at current exchange rates, non-monetary items like inventory and fixed assets being remeasured at historical exchange rates, revenues and expenses being remeasured at the rate in effect when recognized or incurred, so the current rate, and any gain or loss from remeasurement is not deferred, it is recognized in net income, specifically in continuing operations. So when you have this functional currency or you're trying to remeasure something into functional currency, you have to use the temporal method to remeasure it. And again, assets and liabilities are going to be current exchange rates, but non-monetary asset items are going to be historical exchange rates, revenues and expenses, the current exchange rate, and the gain or loss is going to be recognized in net income in continuing operations. By contrast, translation, so there is a difference between remeasurement and translation. By contrast, translation of functional currency financials into the reporting currency, such as for consolidation, uses the current rate method, and translation adjustments are recorded in other comprehensive income or OCI. So when you are remeasuring to get to the foreign currency, you have to use the temporal method. But when you are translating from the functional currency to the reporting currency, you're again doing translation, and that's going to be an OCI instead of net income. So one more question there that kind of helped us understand a little bit more about functional currency and how it fits into the things that you're going to need to know for the bar exam. Now, before we do anything else, let's do one more part of the Superfast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 or 4 questions trying to teach you about the difference between translation and remeasurement, or trying to teach you about how to figure out what the functional currency is. Again, whatever the case is, these are the things that you notice throughout the questions that you do in your review course. And so you take a moment and you write these out as the pillar topics based on what you learned from the questions. So as you're doing this each day, you are building your own personal repository of the most important things you need to know for the exams based on the questions that you did. So let's go to the pillar topics for this video. Okay, here we are at the pillar topics. I kind of did shorter ones, more straightforward ones in this video. Let's just go through them. Functional currency is based on the primary economic environment. And remember what that means. That means where most of their cash inflow and outflow is happening. Reporting currency is used in the parent's consolidated statements and may differ from the functional currency, and that's something we learned. Subsidiaries typically measure their financials in the functional currency. Now, we did see in question 4 that they weren't doing that, and so they had to be remeasured into the functional currency, but typically they measure their financials in the functional currency. Remeasurement is required when books are not kept in the functional currency, like I was saying, and gains or losses go to continuing operations. And then translation occurs for consolidation into the reporting currency from the functional currency, and gains or losses go to OCI, not to continuing operations. Now with that, again, those are the pillar topics, the basic ideas that we learned throughout these first 5 questions, and that is the end of the YouTube version of this video. Remember, we only went over 5 questions, but Superfast CPA Pro members will get access to the full 10-question version of the video that I'm about to finish after I finish this, so that they can get a little bit more help and a little bit more understanding. So if you liked this video and the other videos that we make or the other products that we make sure you check out becoming a Superfast CPA Pro member so that you can get access to these full versions of the videos. And the easiest way to learn about and become a Superfast CPA Pro member is actually by going to SuperfastCPA.com and signing up for our free 1-hour webinar training so that we can teach you the key ingredients to passing the CPA exam And again, in that 1 hour, you will learn so much, and then you will have a better path to learning about and becoming a Superfast CPA Pro member. So check out the webinar, check out becoming a pro member. Again, if you like the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.